and gentlemen, we're live on Zoom and at the same time also on YouTube. Today, we are focusing on the Inner Cycle Trading ICT 2024, the latest version of it, Trader's Foundational Guide. Permit me to quickly put a pause here and allow this to come up again. I'm sure everybody can see my screen and we are ready to fly. This course is more of a practical blueprint for a huge progress on the long term in the financial markets. We have decided to make this as simple as possible and created something like a blueprint that can be experimented in real life. But before I go up all the way into all of this, I want to take you through the subtopics we'll be looking at from our day 1 and day 2. We started talking about some concepts, and I mentioned some key words like swing points. I want to describe it today. Equal highs, equal lows. I want to describe it in the diagram so you can see it. Range, discount and premium, optimal entry, trade entry, optimal trade entry, OTE, imbalance and inefficiency, BC and CB, FVG, VI, volume imbalance, gap, high probability order block, daily bias. Very, very quickly, straight to the point, with as simple as we can make this happen. What is a swing point? A swing point is formed when you consider 3 candles. You can identify a swing point easily when you are considering 3 candles. The color of the candle does not matter. But if you have one candle here that has a shadow that is high, with a candle on the left-hand side that has a lower shadow, and a candle on the right-hand side that has a lower shadow. This candle that was able to go higher above the left and right is called the swing high. So you find this in the midst of price movements. Then you see the 3 of them. This is swing high. In this case, you find this in the midst of price movement. Then you identify 3 candles like this. This candle is identified as swing low. This is a higher low than this. This is the lowest one, so we call it swing low. So we would have said lowest low, but the general name for it is swing low. The next thing I would say quickly, because I don't want us to overflog any point and make that point look as if it's so important. There's nothing important about swing high or swing low. It's common, it's easy to see, it's easy to locate, just as you can see from the picture. The next one I will talk about is what we want to do with a swing low, or what we want to do with a swing high. What we expect from a swing low, what we expect from a swing high, what we detect from a swing low or a swing high. And that thing is important. It is called liquidity. Anytime you see a swing high, some other traders are seeing top. They are seeing resistance and support. Some other traders are seeing it as a swing high, double top or double bottom, or peak formation. But inner cycle traders, they see swing lows as sell side liquidity. They see swing highs as buy side liquidity. So in this training, I want you to consider every swing low as an area of sell side liquidity. When a swing low is formed, you must know that a lot of traders put their stop loss under it. That's what I say here. A lot of traders use that swing low as an area to place a lot of sell orders. Because if a trade breaks out that zone to the downside, it is the beginning of a new direction to the downwards. So a lot of traders want to put a pending sell order from that swing low area. This is why institutional traders or the institution recognize this area under the swing low area as the liquidity area. So a lot of money is gathered in that zone under the swing low or above the swing high. This is the information I want you to put at the front of your mind before we start discussing. This is not my main point. I'm just defining these things because we are going to use them very soon. Now you have the market like this. I want to identify a swing high for you to see. I want to identify also a swing low for you to see. If you look carefully on my charts, you will see there is a shadow on this green line. If you look carefully, you will see it. That shadow ended here. If you look also carefully on my screen, if I send the PDF, you will see it. It's actually very tiny, but you will see the shadow here long down to this downside. So this tip is called the swing high. Why is it swing high? Because it's in the midst of three candles. 1, 2, 3. So for it to go up, these other ones did not actually go as high as that one. So for it to go higher than the left and right candle, it is regarded as swing high. It must not be necessarily here or here. Those places are also swing high, but they can be swing high everywhere in the markets. Not any particular place that is significantly evidence that there's a swing high here. Swing high can occur anywhere in the market. So far, you can count 3 candles and one of them appears higher, the other 2 are lower than the highest one. That is a swing high area. That area has liquidity. Anytime I say swing high, the next thing that should come to your mind is liquidity. There is liquidity gathering above it. As well as this other one. Look at this is a swing low. Why is this a swing low? Because there is a candle on the left-hand side. There's another one on the right-hand side. So this one happens to be on the middle, and it's the one that is lower to the both on the left and right. So 3 candles forms what we can consider as a swing high or a swing low. Only 3 candles should be considered to identify a swing high or a swing low, not a stack of candles. So I want you to think this way when identifying a swing high and a swing low. As we go forward, I will talk more about this and I will show more of swing highs and swing low, and I want you to easily identify them. Still talking about identifying a swing high or a swing low. Here we have a situation here. So many swing high and swing lows have been identified here. Why was this called a swing high? Simply because there is a candle to the left-hand side, there is one to the right-hand side, and this one in the middle is the one that went high among the 3. That is why we call it swing high. Look at this one, it's called swing low. Why? Because this is the candle in the middle, this is the candle on the right, this is the candle on the left, this one in the middle went down below. That's why we call it swing low. This one is also a swing low. Why? Because to the right-hand side there's a candle, to the left-hand side is a candle. Now you see my argument is based on 3 candles. My argument for which candle should be called a swing high or which one should be called a swing low is based on 3 candles. This one has a candle to the right-hand side, a candle to the left-hand side, but the candle in the middle protruded to the top, went up with a shadow. So the end of that shadow, the peak of that shadow is called swing high. Remember yesterday I was describing a candle in itself and I drew a candle. Oh my goodness. I drew a candle and I told you that a candle have 4 parts. 4 parts. One part is, this is a green candle. Of course, that bullish candle, right? This is a green candle. So this part is called close. A lot of people don't know this, and many times when I say close, they find it difficult. They confuse this close to this point here. This point is not close. This point is called high. So when we now say swing high, you know we are referring to this point in a candle that is the highest among 3. When we say candle close, we are referring to this body of a candle in a bullish candle. This is the close. When we say candle open, in a bullish candle, we refer to this side, OPEN, open. These are elementary. I want to call them out because this will be very important in the next page. When we say low, this is a candle low. So if this candle low is in the midst of two candles, one on the left, one on the right, which are not as low as this one, so this place automatically becomes swing low. So this is the low of the candle, this is the open of the candle, this is the close of the candle, this is the high of the candle. Very important information I just give out right here. Please, very important. I don't want you to forget this. In the case of the bearish candle, the one going downwards, in the case of the bearish candle, the one going downward, this is similar, but the only difference is that this one is going downward. Therefore, this is the candle open. It opens from here. It closes here. So this is a close. This is still the low. It doesn't change. This is still the high. It doesn't change. So when I'm talking about swing high, please, I'm not referring to this part. When I'm talking about candle open or close, I'm not referring to this part or this part or this body. No, I'm referring to the body of the candle. Please, I don't want to repeat myself so much on this. I don't want anybody making that mistake. Let's get this correctly. The next, I want to now talk about what happens when you have swing highs gathered together in one location. We call them stack of swings, or we call them equal highs. Equal high is a professional word. Equal high is a situation in the market where several swing highs, sorry, this one is not part of it, sorry. This is a swing high. There's a swing high here. Why is it a swing high? There's one to the left, one to the right. There's also a swing high here. Why is it swing high? Because there is one to the left, one candle to the right. There's also a swing high here. Why is it swing high? There's one candle to the left, one candle to the right. There is a reason why it's called a swing high, and it's one candle to the left, one candle to the right. That's all. Nothing else. There's a swing high here. This one to the left, one to the right. The one in the middle is the highest. Went up the highest. So where all of these candle, we draw a line to all of this candle like this, and we notice that all those highs, they align within the same area. So that area is called equal highs. Why am I bringing this topic or this word equal highs? Because I'm about to say a statement in the next slide, which will really need you to understand equal highs and take note of equal highs when you see equal highs. Equal highs can also come into the market with a combination of this swing right here. Then this is also another swing. Why? Because of this and this. Then this one also is another swing. Why? Because of this and this. So we have three swings here, and they're all in the same area, gathered together. And remember, I say anytime there is a swing, under that swing, there is a region which we call that region SSL. What's the meaning of SSL? Sell side liquidity. What is the meaning of that? A region, there is an unseen region right above this swing. That region is called BSL. What's the meaning of BSL? Buy side liquidity. Directly above every swing, a lot of stop loss gathers there. If there are more than one or two swings gathered together, it's called equal highs or equal lows. It forms that it creates a lot of liquidity. And what normally happens when that is going on is a sweep of liquidity. That brings the word sweep of liquidity. When a lot of equal highs gather, what the price tends to do is to find an opportunity to sweep it off. The price will run into them and crush them over, hit all the stop loss that were gathered here, all the sell entry gathered here, all the pending orders, take all the profit out, and the price will run with speed out of that thing again outwards to go and clear this other side. That brings me again to what I said yesterday. I want to repeat it here. I don't want you to forget. Every institutional trader see the market doing only two things. Number one, every institutional trader see the market going to take liquidity. Number two, all the institutional traders, they have gang up together and they are looking at the market in two ways, going to take liquidity or going to fill up an imbalance. So it is you, the amateur traders, you and I, the retail traders, they are looking at the market. We say Gatli, we say bat pattern, we say crap pattern, we say M pattern, we say W pattern, we say top, we say double top, we say triple top, double bottom, we say Elliott wave, we say Fibonacci retracement, Fibonacci extension, harmonic price pattern. We say, we name so many things. We say Forex Factory. We say CPI. We say, what's this? Thank God it's Friday. Which other one? We mentioned so many things in the textbook. But the institutional traders do not regard all these things. All they are looking at when they see the market is the market is going to take liquidity, stop loss of retail traders. The market is going to fill up imbalance, discount, and premium. So this makes their market or their trading very easy and simple. This is why they don't use the candles. The banks don't use the candles to trade. They use the lines because they are only going to take liquidity and they're only going to fill an imbalance. All right. Let me not give so much information on this page. Here we are talking about a new concept, not really a new concept. We want to give name to something you already know. Because we have a swing low here, we have a swing high here. The space, is it a space now? This is called a range. What is happening in between is a range area between swing high and swing low. The same thing here. We have a swing high here, we have a swing low here. In between, all the road downwards is called the range. So this can be going up, down, up, down, up, down. So we say this is happening in between the range. The price is in the range. Yes. So you hear us using the word range. That is what it means. So that is the range. That's what range means. Very importantly, when you identify a swing high, you identify a swing low, and you see a movement from swing low to swing high, and the market is going upwards. You want to take a buy on that market. You want to take a buy on that market. There is something you need to consider. It is called premium and discount. The easiest way I can help you remember this is a football pitch. When you have a swing high and a swing low, always remember a football pitch. You have the goalkeeper, you have the goalkeeper, you have the middle line, you have the center line. If you are in this part of the football pitch, you are sending the ball from your side here, crossing over to that side to go and score. So the buyers are here. They want to buy from the discount area to go to the premium area. Why the sellers, they are here. They want to shoot from the premium area to come down to the discount area. So do not look for buy entries at premium. No, look for buy entries at discount area, at this level, at this level, at this level, at this level. Once the price is above discount, that is no longer a good area according to discount and premium philosophy. Do you want to buy when the price is high? No. You want to buy when the price is at discount, cheapest. So you have to wait. If you have a movement, market movement where price is scaling upwards, you can see that from the trend, the price will usually tend to retrace downward. When it retraces downward into the premium discount area, that is when you should look for buy entry at discount. So you should know that discount is half of the swing high, swing low, premium as well. Just share it halfway like that. You will understand this as we go on because I'll use it in several examples. This is the same thing when we are dealing with a bearish movement. When there is a bearish movement, the price is going to retrace backward. When the price retraces into the premium area, that's where you look for sell. Don't sell in a bearish trend Don't sell when the price is at discount. How do you know if price is at discount? When you identify the swing low of that move, when you identify the swing high of that move. You know if the price is at discount or at premium. Don't be looking for sell trades at discount. Look for sell trade at premium area. So you allow price to retrace into premium. So you look for sell entries. So you come down to this, you sell it downwards. So that's why I say here, look for short trade into premium. Short into the premium, you look for short trade. Short means sell. I see some people writing on the chat box saying, can't actually hear you properly, Mr. James. Somebody say, please let the meeting be recorded. It will help the learning process. Of course, we have day 1, we have day 2, today is day 3, and we are live on YouTube. So if you can't hear me, go to YouTube at James Ochima. You will see this call currently going on live on YouTube. So you can watch from YouTube. I guess your Zoom connection is not really okay. So if you can hear me, please put yes on the chat box because I'm going on now to the next subtopic. Catherine from Canada can hear me. I'm happy to have you on the 3rd day on this call. You were here all through to day 3. Please don't miss this day 4. Don't miss day 5 because day 4, we are going to be looking at the live markets. And we'll be picking out everything we have discussed from day 1, day 2, day 3, and we'll be showing you live inside day 4. So day 4 is like dress rehearsal. And day 5, we are going to analyze the market and place the trade together. Several trades, we are going to call the trade and place the trade together on our demo account. I assume that everybody have their demo account ready. So on day 5, which happens to be Friday, we are going to all be trading. So I want to talk about OTE for a long trade. That is optimal trade entry. Now you know what a swing low is. You identify it. You draw the line. You know what a swing high is. You identify it. You draw the line. You can also use your eyesight to measure. Half of swing low, swing high is the premium upward, the discount downward. There is an area inside the discount area. You know you want to buy now, right? Why do I know you want to buy? Because this is an upward trend. So the market rose from swing low, the market rose to swing high. So the market will discount, or we say retrace, but the right word is not retrace. Retrace is for elementary and small traders. But you as a professional trader, you will say that the market will discount. Once the market discounts, where are you going to enter your, not where are you going to enter? Where is the most optimal? Optimal is the same as most, right? Where is the most high or safest area to buy when the trade is discounting? Is this discounting? Let me make dotted line. Should I buy from here? The answer is no. Buying from here is very risky. Why is it risky? It's risky because this area is the same level as a swing low area. And remember, I said under a swing low, there is a stack of liquidity. So institutional traders, when the market comes to swing low, they always want to sweep it out. So they will push it down and it may just keep going down. Sometimes they'll push it down very quickly, hit all the stop loss and push it upward very fast. So you don't start buying from that swing low area. It is not an optimal trading area. Some people can buy there and make profit. It's called fluke. It's called luck. That day, the market makers did not want to wound you. So to be a professional trader and to take an optimal trade that is a high probability trade, you need to know where is the safest place for you to start buying. It's obviously not at the swing low area. It's obviously not very close to the swing low area because there's what you call market maker. They can manipulate you, allow the price to come up a little bit so that you can buy, and they will still bring you down. So there is an area we call the OTE. OTE is at halfway between the discount and the premium. is at halfway between the discount and the premium. Oh my God, I made a big blunder. I said something different. It's at halfway in the discount. That's what I mean. I didn't say halfway between discount and premium. Sorry about that. I said halfway in the discount, in the discount area. This is what I mean. This is the discount area. Halfway the discount area is the OTE area. I don't want to give you these numbers because these numbers are mathematical Fibonacci numbers, and I don't want these numbers to bother you. So permit me not to mention the numbers. They are not relevant. Just look at half of the discount area. So when you are in a bullish push, you identify swing low, swing high, and the price discounted, you allow the price to discount into half area of the discounts. And if you remember yesterday from day 2, I was talking about 50% consequence encroachment of fair value gap. So this is similar. So you know the same application, what you give to fair value gap, is the same thing now you are now giving to the discount area to look for OTE. So OTE is the same principle with the fair value gap entry, 50% encroachment, consequence encroachment. Forget about my grammar. 50% means half of the fair value gap that was drawn. Forget about my grammar. OTE means half of the discount area that you have identified. These are very simple to remember. Halfway is a good place to start trading as optimal trade entry. So the same thing for the short trade, that is the short entry. If you have a bearish trade which is coming down and you allow the trade to go back to premium so that you look for entry. Are you going to look for entry from this point? It's too early to sell. Allow the trade to go halfway. Sell from halfway. So if it goes and close above the premium, you get out. That trade has already broken that swing high. It's no longer your entry. It's no longer your entry again. Your entry is at halfway in the premium. That is the entry for short trade or sell trade on the OTE, discount and premium concepts. Well, I don't want to bug you so much about this. I want to show you on the chart so you understand the optimal trade entry area. Here is a chart, and I identify a swing high on this chart. Where's the swing high? This one. And I marked it, and I draw a line there. I identify a swing low on this chart, a stack of swing low. Here are they, this one. And I mark them. And the current price is here. This is where the current price is. So from swing high down to swing low, half of it is this place is premium, this place is discount. And remember, we say, if you want to buy, the best area to buy, which is the optimal trade entry area for buy, is half of the discount area. So this area here is the best place to buy. To buy, go all the way to the top. Why I'm emphasizing on this is because so many traders I've seen, retail traders, lose money. When the price fall down from swing low, from swing high down to swing low, when they see the price as swing low, they know that this is a swing low. The next candle they enter a buy here. They call it sniper entry. You will do that sniper entry and drink sniper and lose your account. That thing is not the optimal trade entry area. That place is a risky area. It's a fluke area. You are entering at a risky point where anything can happen. So you are going to be very, very lucky to always have the trade peak at that point, because many times the next candle can come down and sweep you off. Many times there can be a move to that side a little bit upward and clear it downwards. So, but if you allow the price to go halfway of that discount, and when the price go halfway of that discount, you can now start looking for entry here based on fair value gap, based on other block, based on what we have learned yesterday. From this optimal trade entry area, it's safe to find a buy entry all the way to the top. And when you take a buy entry, of course, you know you are going to the liquidity, which is the swing here. You are going to clear the liquidity. So you can do the trade from here. The stop loss is under the swing, which is normal. Then the take profit is 1:1, 1:2, 1:3. It's clear from here. This can be any time frame. It doesn't respect time frame, it doesn't matter. So I see people from the chat box, they are dropping some comments. They say, can we use Fibonacci to make these zones? No, you don't need Fibonacci. I don't want to stress you guys. You can use your naked eye to make these zones, your naked eyes. You don't need so much on your chart. You don't need Fibonacci. However, at the end of this course, I will show you a ruler. There is a tool on TradingView where you can pick that tool and it will automatically draw this discount and premium. But if you use your naked eye, you can see swing high, mark your swing high, swing low, mark your swing low. You know the middle. Then you know the middle of the middle. So it's easy. So you don't need to be going to consult Fibonacci. Why I don't really want people to consult so many tools is because the moment you start consulting so many tools in your analysis, it will make you feel you have worked so hard, so the analysis is correct. Meanwhile, you can just look at the whole thing and see where you are and decide without even drawing any line. So if you put so much effort have a way of making you feel that you have achieved results. Meanwhile, it's just effort plus effort plus effort, and it can still be wrong. So here now, we have the opposite situation where we identify a swing low here, we draw the line, we identify a swing high here, we draw the line. Then half of the swing low and swing high differentiate between our premium and our discount. Then if we want to buy, of course, we are buying at discount, which is this zone here. And the best place for us to buy, of course, I see this is swing high to swing low. So this is an upward movement, right? So if it pulls back down to this area here, this area here happens to be the good area to enter, which is called the optimal trade entry area, not this place here. This is the optimal here, not here. Thank you. Very, very important. We mentioned this. So this is not a strategy for entry. This is just showing you area that is safe for buy or for sell within a swing. The safest area within a swing is called optimal trade entry. Now let's begin to dive into what my main landing point will be. I'm going to land somewhere where I will connect everything I've said together. I will land somewhere very soon. Remember yesterday, we started talking about fair value gap. Now, the general nomenclature is imbalance and inefficiency. BC and CB. Anytime you hear BC, it's saying buy side imbalance, sell side inefficiency. That's the full meaning of BC. Now, we can use this to describe a fair value gap in the sense that we said there is three candle 1, candle 2, candle 3. Candle 1 high ended here. Candle 2, we don't even touch it. But candle 3 low started here. So the gap between candle 1 high and candle 3 low in a bullish move, that gap is called FVG. This is what we say here, creating a gap called FVG. So for the purpose of those who did not attend yesterday, you need to go back and watch that day 2 video describing FVG, explaining it, because we're about to use it massively right here now. The same thing, if you have a bearish trend, move in the market, the first candle, the second candle you are considering, the third candle you are considering. Remember I said any 3 candle can be considered. The color does not matter. Any 3 candle can be considered. The color does not matter. But if the candle is in a bearish move, it's called a bearish fair value gap. This is why we are using color, so you can know the various movements. The first candle you mark, the second candle you leave, the third candle starting point you mark. That gap is called fair value gap. Now we can discuss, or we can mention stuff like CB, sell side imbalance, buy side inefficiency. That's the meaning of CB. In case you see it on any analysis, that's what they are talking about. Now, as we begin to go gradually into my main points, may I at this point tell you what to do when a fair value gap refuses to work. But before a fair value gap is refusing to work, how does it work? How do we trade a fair value gap? Somebody asked me that question. A fair value gap that was formed in a bearish move that was going down by 1, 2, 3. And you mark the fair value gap like this. We already said yesterday that the middle of that fair value gap is called the 50% consequence encroachment. After the gap has been formed, we expect that price will retrace back into the fair value gap. When price retraces into the fair value gap, we expect that the fair value gap will serve as a springboard or a magnet that repels price away to continue the direction of the fair value gap. Therefore, when we see price retrace into fair value gap, we use that place as our entry, sell entry here. Sell entry here, our stop loss is above the fair value gap. Because if price close after the fair value gap, that fair value gap is invalid and our SL will help us get out. Some traders leave their stop loss above the first candle that formed the fair value gap. I just know that the moment a fair value gap candle closes above it, that fair value gap is invalid. So the reason why you enter that trade is now invalid. So why are you still in that trade? Get out. So you get out by risk management, you get out by the candle, depending on your time frame anyway. But you just know the candle is invalid. The candle invalidated the fair value gap if the candle already closed above the fair value gap in this case. I want to explain again. A situation whereby we have a bearish move in the markets. Fair value gap formed. What type of fair value gap is this? Remember yesterday we talked about a fair value gap type called breakaway gap. This is the breakaway gap. And we talked about another type of fair value gap, which is called regular fair value gap. I don't want to go back there. That's not my point. My point is that the moment the fair value gap has been formed, you mark the line for fair value gap. We are expecting price to retrace back into the fair value. In the first situation, scenario 1, the price actually retraced into the fair value gap, but the body of the candle that retraced did not enter into the fair value gap. Is that fair value gap a good one? Yes, it's a valid one. Place the trade there, sell, and to bring us downward. What if we have a situation whereby the candle body enter into the fair value gap? It's still a good situation. Even up to half, it's still a good situation. Even up to 75%, it's still a good situation. But when the candle closes above the fair value gap, it's a bad situation. We are not going to use that kind of fair value gap. What am I saying? I'm saying that if the candle body enters the fair value gap, we can place our sell entry inside it. So the price will come down. We expect the price will continue in the direction of the fair value gap because the characteristics of a fair value gap is to bounce back price after the fair value gap is formed and price pull back into the fair value gap. The fair value gap acts like a magnet that repels the price, push it backward, outward. So we can use this place as entry point for sell order. So I actually wrote SL here. It's supposed to be sell, S-E-L-L, sell. So we sell here, we enter here, EP, entry points. We sell here, we push the price downwards. In pushing the price downwards, our take profit area is the next swing point. The next swing point. I will show you that in the live market. I'll show you that in the live market. The next point is fair value gap inversion. This is what I really want to talk about, but I had to show you the fair value gap normal expectation. This one is a fair value gap that has been nullified. So we say inverted fair value gap or fair value gap inversion. So let me explain. Look carefully at the charts. When we have, for instance, a bullish move in the markets, and we notice that there is a fair value gap in this bullish move. Fair value gap has been formed, candle 1, candle 2, candle 3. And we expect that after fair value gap is formed, the candle should pull back into the fair value gap, which happened here. But this pullback of the candle did not stop halfway. It encroached and completely closed below the fair value gap. When we see this happen, this process or this attitude of this candle closing across the fair value gap is called inversion. When we have a fair value gap inversion, what do? You don't expect the price to continue in that same direction anymore. Whenever there's an inversion, it means that the price is attempting to go the opposite direction. The price is attempting to go the opposite direction. That's what it means. So what do? You watch out for the next candle to go and test the fair value gap 50%. You enter a sell. S-E-L-L. Yes, price was going up. We were supposed to pull back and continue buying, but the fair value gap was invalidated, and the next candle tested it, enter a sell there. Now, you don't be quick to enter a sell in the next candle, please, because you are trading an inversion. So you wait for that candle to confirm. This candle is a confirmation for inversion. This candle is the inversion, I beg your pardon. Why this candle is the confirmation? The next candle is your sell candle. You sell it downward. Because this candle confirmed that this inversion will hold. Therefore, the next candle you sell it. I will explain again from the other one. I will explain again. We have a price movement which is directed downward. A fair value gap was discovered. After the fair value gap was discovered, we expect that the price will pull back into the fair value gap and continue the same movements. So we can take a sell from here to go down. But when we were waiting, we noticed that the price closed above the fair value gap, invalidated the fair value gap. So that downward movement we're expecting will no longer hold. That's what this candle means, by encroaching over and closing above the fair value gap. So that process is called inversion. When an inversion happens, please don't start buying because you saw an inversion. Wait for the next candle to test the 50%. If the next candle successfully tests the 50%, either by body or by wick or by whatever it's going to use, after the next candle, which is a test, this candle is called a confirmation of that inversion. The next candle is your entry. Anywhere the candle starts from, whether here, whether here, whether here, anywhere the candle starts from, you enter that candle and you drive it all the way to the top, to the next swing point area. This is how to trade a fair value gap inversion. Just like how you learn how to trade the fair value gap, the normal fair value gap versus the fair value gap inversion. Please, if there is anybody on this call right now who have understood what I've said, please put 1 on the chat box. Because the way I'm explaining it, even in my mind, I'm feeling like some people are not understanding it. And it's not your fault, because the first time I saw this, I had to look at it again very, very well before I made sense out of it. But the way I'm seeing the chat room right now, it's like I'm doing a very good job here. A lot of 1 in the chat box telling me that people understand it. So there are 2 concepts here I expose here: the fair value gap itself, how to trade it, and also the fair value gap inversion itself, how to trade it. Those are those 2 things that we have been able to establish here. And we are gradually rolling to the end. Volume imbalance. What is volume imbalance? Is it a different thing? It's not a different thing. It's similar to fair value gap, but it works, it appears with only 2 candles, not 3 candles. Whenever you find in the market any 2 candles that did not overlap each other with the body. Only the shadow were overlapping each other, but the body did not overlap. That space is called volume imbalance. The same respect you have accorded FVG, you fair value gap, you accord this volume imbalance. The same way they work, the same characteristics, the same way we trade them, the same thing I said, the conditions for fair value gap, what you do with a fair value gap, the same thing you do with a volume imbalance, the same. The difference between the volume imbalance and a fair value gap is the fact that the fair value gap has 3 candles. The volume imbalance, the volume imbalance just 2 candles, and it's just wick that are overlapping. The bodies do not overlap. And let me tell you something about the volume imbalance. You can compare them to Navy in comparison with Army. Army are rampant. In Nigeria, we see Army people almost everywhere in the markets. We see them almost everywhere in the community, almost everywhere. We easily see Army people. But Navy people, they are also there, but they are not easily seen. You don't see Navy people everywhere with white, except maybe you go to Navy Town. Even in Navy Town, you don't see them with white almost everywhere. They are not easily seen. They are there, but they are not easily seen. They are scarce to be seen. I think one of the reasons is because a lot of them are in the waters. So you don't see them on land so as much as the Army guys. I'm bringing this analogy because this is the same with fair value gap. Fair value gap, they are like Army. You see them everywhere in the markets. But the volume imbalance, they are like Navy. You hardly see them. Once in a while, you can see them. If I ask you now to go to a chart and go and circle a volume imbalance and screenshot and show to me, a lot of people will not find it because you hardly find them. But whenever you find them, the same way you respect first value gap, that's the same way price will respect volume imbalance. Volume imbalance can be bullish. Volume imbalance can be bearish. The next thing now is the next concept I want to talk about, the gap. The gap, let me just say, you can see the gap in the markets more than the volume imbalance, but the fair value gap are more seen than the gap itself. Gap is a situation whereby the wick of this, of course, 2 candle formation. Gap is a 2 candle formation. The wick of the first candle 1 and the wick of candle 2 do not even overlap. There is a purely no trading zone in between the high of candle 1 and the low of candle 2. Nothing happened there. It's empty. So it is called a gap. The same thing for a bearish move. The wick, which is a low of the candle 1 and the low of the high of the candle 2 do not overlap. There is a gap, no trading zone. Nothing happened there. So it is called a gap. There's a bearish gap, there is a bullish gap. Water. Okay. We've talked about 3 things, and I don't want them to be confusing, so I'm going to show you the 3 of them at the same time. Fair value gap, volume imbalance, and gap. What are the differences? One of them is a 3 candle formation. The other one is 2 candle formation. The wick are interwoven or encroach each other, or overlap each other. The third one, they don't even touch themselves at all. This is gap, this is volume imbalance, this is fair value gap. The same thing we do with fair value gap, the same we do with this, the same we do with this. They work the same way. They attract price and they repel price. They act as springboard. So we use their 50% consequent encroachment when price leaves. Then price will come back there and use that place as a springboard to go. And price can invalidate that place. We turn it into an inversion. volume imbalance inversion, gap inversion, fair value gap inversion. Don't forget this. Very, very important. Rewind this video and watch again. The same thing we consider when we are talking about bearish move, bearish fair value gap, bearish volume imbalance, bearish gap, bearish gap. Of course, give them the same respect, use them the same way. The next thing here we're talking about is high and low probability order block. We are coming gradually to the end of this slide. What is a high probability order block? A high probability order block is a huge candle size order block with a large candle body, as you can see, more than the wick. So it's a high probability order block, high probability bearish order block. It's large candle. Simple to understand. A low probability order block is that order block that the candle body is small. So I pay more attention to this high probability one. I pay less attention to this low probability order block. This order block will be respected and taken seriously in the market more than this one. It can easily be violated. So please bear this at the front of your mind because we are going to use it very soon. All these things I'm showing you is because we are about to start using all of them. This is the final bus stop where we are going to use them. Everything I've shown you from the beginning of day 1, day 2, day 3, this is where we need it. Here on this page. This is a summary of everything I've been showing you guys. This is a summary. Bullish order block, fair value gap, sell side liquidity, break of structure, market sweep. Everything is on these charts. Look carefully, you will see everything I've taught you is on these charts. Everything we need is here. Yes. We have a situation in the market. Price was coming down. Price formed a swing low here. Remember, we don't call it swing low as professional. We call it sell side liquidity, SSL. So there is a liquidity under this place. When price forms swing low here, price goes up, forms a high here. Price is looking for a way to come down and break this swing low and sweep off all that liquidity. And when that happens, it's called a liquidity sweep. After a liquidity sweep, the price will push up with speed. We are looking forward for that. Now, a liquidity sweep has happened here. So we expect that after a liquidity sweep, we want to look for any fair value gap that will be formed here. Any fair value gap that will be formed after a liquidity sweep is a very good fair value gap. Remember that? We will pay attention to that fair value gap because it is formed after a liquidity sweep. Therefore, it's a very strong fair value gap. I can see there are several fair value gaps here. Another one is here. FVG. Forgive my line, it's not straight enough. So I see two fair value gaps formed here. Another thing again I see here is that this fair value gap that are formed in this push of the market, they broke another liquidity here, break of structure, BOS. So that means that this price here has changed character to the bullish direction. So this other block is going to be seriously respected, is expected highly to be seriously respected, push to the downside and up, either soon or later in the future or whatever. Or this other one here will be respected and up all the way up to the upside. So this kind of structure is what we are looking for anytime we are doing analysis. If we find this kind of structure in any market, we will eat it and lick the plate. This is a high probability buy setup. If we wait for a pullback into a fair value gap, we are going to take that trade from here and we're going all the way up here. There's a high probability, high chance of us hitting take profit 3 with this kind of setup. Sell side liquidity, acknowledge. Break of structure, acknowledge. Now, even I didn't mention this other one. Let me mention it now. A high probability order block. High, I don't want to write acronyms. But let me just put OB here. Inside your mind, you see this, you know that this is high probability order block. Again, what is order block? Order block is the negative candle that is formed before a large movement of a positive candle. A positive candle can be a red candle, it can be a green candle. A candle where in perspective, 1, 2, 3, green, 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 there's a liquidity here. Push. Volume is added, volume is added into the markets. A lot of volume has been added into the market. the negative candle that happened before, that was printed before that volume was added, that negative candle is called an order block. If the order block has a large body, it's called a high probability order block. So here we have order block, we have sell side liquidity, we have a sweep of it, we have a break of structure, we have fair value gap. This market is a high probability setup. If you see this market, enter the trade, go and sleep. You are going to take profit 3. Out of 10 trades, this type of setup will give you 5 or 6 take profits. So what are they saying here? Bullish candle or series of bearish candles that sweep the sell side liquidity before taking the break of structure to the upside. So this is very, very important setup that we are looking for. This is the basis of this strategy we are teaching for 5 days. This is the basis. This is the opposite direction. That is the same kind of setup in a sell move. If you see the movement forming a swing high, which is, we call that swing high buy side liquidity, buy side liquidity. And it forms a swing low. And there is a liquidity sweep. When you see that liquidity sweep, the price started forming that movement in response to the sweep of liquidity. After a sweep of liquidity, we expect a sharp downward movement like this. When you see that sharp downward movement and it has broken structure, it's a BOS, break of structure, change of character. And it printed an order block here, OB. The last thing to find here is order block, fair value gap, and place your entry. Since we already have order block here, I don't want to look for fair value gap within this zone. There's order block here. It takes care of us. I'll look for fair value gap here. This one and this one, FVG. So my FVG have been formed. I will mark my line. Ladies and gentlemen, I'm going to wait for this price. Any day price comes into my FVG 50%, I'll enter here, entry points. Sell, the price is going to go down. This is all we are doing for the past 3 days. And this is all we'll be doing for the next 2 days. And this is all we will use to make $25,000 every month. This strategy always works. High probability strategy. This one. So you have to strive to master this setup. A setup where you see break of structure, you see buy side liquidity swept, you see high probability order block, you find a fair value gap in it. Oh my goodness. You find that structure, put your money there, close your eye and sleep. You are already a millionaire in this market. If you lose out of 10, you only lose 3 or 4. I bet you. Go and backtest this strategy. Go and find exactly this thing. Label it. It's your assignment. Label all these things and put it in the market and show me what happened to the order. What happened to the fair value gap after this setup was formed? What was the result of the fair value gap? Was it violated? If it was violated, we will trade the inversion of that violation and you will see that we'll make profit on the inversion. Yes. That fair value gap must be treated with respect. Either it's not violated, it will go down. If it's violated, the inversion will work well. The bullish candle series of bullish candle that sweep the buy side liquidity before breaking the structure to the downside. The last thing I'm going to talk about here before we leave, this is the second to the last page, daily bias. A simple way to determine the next day. Now you see the color I printed here in blue, next day. Because when I begin to show you daily bias now, I don't want you to use daily bias as an entry point. I don't want to use daily bias as a way to analyze what is happening in the market right now. I don't want you to use daily bias to look at the market and see what is happening yesterday. No. The purpose of finding daily bias is to know what is likely to happen in the next day. It's not to find an entry. It's not to predict the market. It's not to enter a market. No, it's to know which direction we are going the next day. It's important for us to know what will happen the next day before the next day. And the way to know is through daily bias. It's very simple and easy to understand. I will show you. But first of all, know that it's based on the fact that you are considering what is about to happen tomorrow. You want to know whether the next day will be bullish, or you want to know whether the next day will be bearish based on previous day high and low. That is how daily bias is identified. It's very important, and I will show you here. If you are looking for daily bias, if you want to identify daily bias, you just need two candles. The candle for yesterday, the candle for today. You will know where tomorrow will be. That's all. If you are looking for daily bias, you don't go looking for 2 weeks, 3 weeks, last week. No. The candle for yesterday and the candle for today, that is all. The candle for yesterday, you will mark it. The high of that candle, the low of that candle, you will mark it. The candle for today, you will check what is happening. The candle for today is still moving because we are in today. So the candle for today will always be moving today. Right? Your question is, this candle that is moving right now, will it close above yesterday's candle? If this candle closed above yesterday's candle, it means tomorrow we are going up. That is the purpose of daily bias, to know where we are going tomorrow. So paraventure is 12 midnight, or this is night time. We're not trading now, but we want to know what will happen tomorrow in the market. Daily bias will tell us what is likely to happen tomorrow. If today's candle did not finish above this yesterday's high, it means that tomorrow we are going down. I will explain this now in the next chart. You understand it better. Repeat or rewind what I've said to hear it again. I didn't make mistake in my speech. What I said, it was correct. Rewind it and hear again. And hear carefully what I've said, because I will repeat it again. If you want to use daily bias to know what will happen tomorrow, you just need yesterday's candle. You need today's candle to know what is happening tomorrow. This is tomorrow. So today the candle is still moving. You mark yesterday's candle. You mark yesterday's candle high and low. You see what is happening today. And you tell yourself, if this candle closed above yesterday, it means tomorrow we are going high. That's why you see tomorrow candle printed like this. It's called bullish daily bias. So if I tell you that we have a bullish daily bias, so you know tomorrow we are going up. Yeah, we're going up. So tomorrow I'll look more for buy opportunities. I won't look for sell opportunities, because my daily bias is bullish. Yes. This thing always works. Go and backtest it. It always works. It always respects daily bias. Just very few of them will not respect daily bias. But if you look at it critically, the market is respecting the daily bias. Look at it again. This is today. This was yesterday. This is yesterday's candle, the low, the high. This is today's candle. Probably the candle was going downward in a red before. But then the candle ended not as a red, in a green, I beg your pardon. The candle ended as a green. Did not close. I didn't say high. Please don't misquote me now. Today's candle did not close above the high of yesterday's candle. Candle closed here. See the close of the candle. It didn't close below the low. This is low now, sorry. This is low of the candle. Today's candle did not close below the low, so we are not going down. That's what it means. If it closed below the low, if there was a red candle that closed below the low, it means that tomorrow we are still going down. Our bias is bearish. But here, the candle could not close below, therefore, our bias is not bearish, our bias is bullish. Tomorrow we are going up. I'll still repeat again with the final charts, the same thing, because we have come to the end. The same thing, there's no other chart again. This is the last page. This is the last page. 9 minutes past 10. Today we were very fast. I will show the live chart to maybe call our attention in summary of everything we have done. This is yesterday's candle, yesterday. This is today's candle. And today's candle is still moving. So we say if this candle that is moving today close below this low, it means that tomorrow we are still going down. Bearish bias. What if yesterday was like this? We marked the high, marked the low, and today was trying to go up, but it could not close above the high of yesterday. It came back inside and closed below the high of yesterday. That means this is no longer going up because today's candle closed below the high of yesterday's candle. Therefore, we are going down. We are going down. Yes. We are going down. We are going down. I got my eyes on you. We are going down. So this is the daily bias. Ladies and gentlemen, these things that I've said here, I'm saying all of them with passion as if I'm teaching it back to myself. I just wish I can break your head, all of you right now, and choke all these things inside your head right now. That's the way I'm feeling right now. But let me go into the main chart and show you right now what is happening on NASDAQ. I want to show you from the last thing we discussed, daily bias. But why is this chart is up now? This is NASDAQ. NASDAQ 100. This is, by the way, this is today. This is a live market chart, 1677. This is a live market chart. This is today. This was yesterday. Daily. This is a daily time frame. So we bring the chart to daily. This is today. This is yesterday. So what am I going to do? I will pick the tools. By the way, for beginners, this is tradingview.com. If you go to tradingview.com, you open the charts, you can see your candles. If you go to MetaTrader 5, you can open your chart, you can see your candles. But this is tradingview.com. It's an online chart platform where you can see all the assets and you can analyze them. I love it because their tools is so lovely. This first tool have trend line. It have also horizontal ray. It have also arrow. Where is the arrow? Arrow is not here, but horizontal ray is here. Trend line is here. I will use this trend line a lot. If I pick it up, you see it's already highlighted, so I can use it. I can mark yesterday high like this, straight line, short one. I can also mark yesterday's low like this. When I do this, I'm trying to identify the daily bias. This is yesterday. So this is today. This candle is moving upward and doing like this today. If this candle ends bullish above this high, it means that tomorrow we are going up. Where's my arrow? Tomorrow we are going up. I don't know where we'll reach as far as going up is concerned, but I can tell you that tomorrow we are going up. That is all. That is just the purpose of daily bias. It's not telling you that enter a buy and go to this point. No. It's not saying that. Yeah, it's okay for us to draw the next swing high. There's nothing bad. This is a swing high button here, this one. If you pick this arrow, you see a horizontal ray. You can mark the swing high. Even the trading view have a way of marking swing high for you. It's okay for you to feel that it's going all the way, it's approaching swing high. This is not what we're analyzing. All we are saying here in daily bias is that we want to know where the market direction is going tomorrow. And the only way we can know is when we see today and yesterday. And if today can close above yesterday, that means our bias is upwards. That's all I'm saying. Let me go to another chart. We're expecting, if this candle close above as a blue, as a green, tomorrow NASDAQ, we're expecting it to keep going higher. Let me check WTI, which is oil, US oil. It's one of our pairs, right? We are trading, see this expectation, I draw it from here and it went there. It's really interesting, this market, very, very interesting. Let me remove this guy so you don't get confused. Let me remove this guy, you don't get confused. So this is the daily time frame, daily, of West Texas Intermediate Crude Cash. It's called WTI. It's called US oil. So if you go to the daily, you just need only 2 candles in the dailies. That's all. The first candle you need was yesterday candle. You mark it with the trend line. Mark it like this. The second candle you need is, sorry, the high and the low of yesterday candle. When you mark it, then you look at the next candle. The next candle is inside, it's within the range. It's trading, this is the current price of crude, $71.5. So if this candle ends below this guy, we are going downward. If this candle ends above this guy, we are going upward. If this candle ends in between, but there's no direction. No, this market is going up and down. This market is ranging. So tomorrow, we don't have a direction for tomorrow on crude. It's going to dance in between the range. There is no clear direction for crude for tomorrow if this candle closes like this. So does it mean that we cannot trade crude? No, it doesn't mean like that. It just means that the daily do not have a bias up or down. It's neutral. So why do we need daily bias? Daily bias is a confluence. If daily bias say bullish and you go to H4, you analyze bull trade. You analyze a buy direction. It increases your confidence. You find your structure, sweep of liquidity, all those things, blah, 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 blah. You find them up. You trade them. Right? Very important. Let me go to another asset again, GBP USD. I will explain daily bias there, and then I will explain the other things we talked about. Here, I don't want to go so much far talking about so many things here. I want to just confirm that people know what daily bias is and how to map out daily bias. When you open the candle, this is GBP USD, daily time frame. Yes. What do? You mark the yesterday's. This is today's candle. You mark yesterday. Mark it. Candle high. Swing high. You mark it. Done. So if I ask you what is the bias? Well, I can't conclude that it's a bullish bias, it's a bearish bias, or it's a range until this day close. It's possible that this day can go and close above, it becomes a bullish bias, we are going up. It's possible that it can go and close below, it becomes a bearish bias, we are going down. But if it closes above, we are going up. And what is our target? Our target is the next swing. So you pick the horizontal, you knock it here. If it closes above, we are going all the way to this swing. Why are we going to the swing? The reason is simple, because that is where liquidity is gathered. We are going to clear liquidity. Why do we always go to swing? Remember, swing is called liquidity for those traders, for those institutions. It's a liquidity area. Look at this. A swing is a liquidity area. Look at this. Liquidity was cleared. So, but I don't want to go backward in this. Let me take this one out. This is liquidity. Liquidity is here. So the intention of this market right now is to go and clear this liquidity. 1, 2, 3. Equal highs. There are equal highs here. To go and clear it. So if daily bias is above here and clear this one, the next target for daily bias is to take off this one. The next target is to take off this one. So price is going all the way to this point according to daily bias if this price closes above this move. I'm going to go down to no, I think I should look for an asset that let me look at Bitcoin, an asset that has a fantastic daily bias. Okay. Let me do something technical here, a little bit different from what I did in the first two. Number one, let's say this is yesterday. Let's say this was today. So this is tomorrow. So yesterday, we mark yesterday. Yesterday, we mark yesterday. Today could not close above the high of yesterday. Therefore, the bias is downward. So the moment we start looking for sell orders. We are bringing the price downward. That's exactly what happened to Bitcoin today. The daily bias was down, and traders who saw it, they took it downwards. Sell. So you now come down to H4. After identifying daily bias, you come down to H4 to look for the sell opportunity for today's trade. Today's trade, where did it start from? Let me go back and see where it started from. Let me assume we saw yesterday, and then we wanted to take today's trade on a sell. Where would we have entered sell on that Bitcoin? I want to go back to see where today started from. That's and the network is now not allowing me. Today started from this place here. Can I mark it? Let me get something like a box to mark it. This one. It started here. Can I change the color? Let me make it a thick yellow. It started here. Today started here. That's the high of today. So we saw the daily bias that the candle closed like this. So the next day is going to go downward. Then we go to the next day. We start analysis. H4 in the morning. Bitcoin is an all-day market. So we can't say 8 a.m. London open or 2 p.m. New York open. It doesn't have any issue to do with Bitcoin. So around this side, around this zone, the market, the day started 4 plus 4 plus 4 plus 4 plus 4 plus 4. Around all of this are today. These ones were yesterday. I can also see that here. This candle is 9th. This candle is 10th. So 10 started from here. From here. So when I look at these charts, what I can see first of all from this chart when the day started was I noticed a sell sweep, a buy side liquidity cleared from here. Let me draw it so you see it. I noticed here that this was liquidity sweep here by this guy, and the price came all the way downward after the liquidity sweep. So after liquidity sweep, the next thing I will find is order block. I'll find my order block. If I see there's a nice push here. If I see order block, I will notice this order block is here, but it's a very tiny order block. So I won't pay attention to it. It's a low probability order block. The next thing I will note is the fair value gap. So how do I note fair value gap? This is the push. So I say candle 1, candle 2, candle 3. So this is where candle 1 ended. This is candle 2, where candle 2 is okay. This is where candle 3 started. So this is the fair value gap. So this is what I can see. After daily bias, I see the liquidity sweep, which supported my fair value gap. And I find my fair value gap. There was a small order block, which is low probability one, but I was able to locate a fair value gap there. And after the fair value gap was formed, price went into the fair value gap, but did not violate the fair value gap. So the moment price entered the fair value gap from 50% of price, so my entry would have not been here because this is the start of the market. I would draw my fair value gap here. After my fair value gap, my entry would have not been here because fair value gap was just formed. And the rules say after fair value gap formed, don't enter until price encroach. My entry would have not been here because the fair value gap has not been tested. It wouldn't have been here. It has not been tested. My entry would have been here. This is my first entry. When I do my first entry, the price will go up, but the price respected fair value gap, so I'm still in the trade. I will only leave the trade or think of leaving the trade if the price closed above fair value gap. But fair value gap was nicely respected, so my trade was still valid. So in the next candle here, I will be in profit because price will now bring me downward, downward, downward. If price is bringing me downward, I will exit my trade on the low of this candle, which is from here down to this point here. Now remember that if I'm entering here, I will not enter with the H4. I will only indicate my fair value gap at the H4 to a smaller time frame to find my structure where I will get entry, take profits, you know. So I will seek a clear take profit, which is actually this swing low here. Fair value gap have been entered. Please, I want to know if you can still hear me because my screen went off. I need to be sure if you can still hear me. If you can still hear me, please, I want to know. Let me take this guy out. I want to mark the parts that would have been my entry if I was to take that trade today. What we are doing is like a back testing. I'm just testing the strategy for you to see. But on Friday, we are going to analyze it and trade it forward testing. We're not doing back testing. We are doing it live, forward testing. It's obviously here now, this one, sorry. So this is a place where I actually entered. This was my entry. This one. So this is the 50% fair value gap area. I want to go down to smaller time frame. I love to go to 15 minutes. So this is the area where I entered my sell because it's the midway fair value gap H4 time frame. This area here. So when the market start doing this thing, this is where I look for my sell. How do I find my sell with all this noise here? So I'm going to look for anything that is interesting, either a sweep. You remember I said market is looking for a sweep, or market is trying to fill an imbalance. I'm going to look for a sweep of liquidity. This is a sweep of that liquidity here. The moment there's a sweep of that liquidity, I'm going to jump in after the sweep of the liquidity. When price do something like this, I'm going to jump in from here. I'm inside this market at this point. Anywhere around here after the sweep of liquidity, I will jump in. Once I jump in, I'm watching the fair value gap. If price closes above the H4 fair value gap, now there is a difference between M15 and H4. At M15, you are seeing that it's closed, but the H4 is what you are paying attention to. So if I go to H4 and I see that the price closed above H4 fair value gap, then the strategy is invalid. So, but after the sweep, I jump into the trade from here. When I jump into the trade from here, I'm looking out for the swing. Where will be the swing? If this is the swing high, where will be the swing low? This one. Because as at that time of the day, all these candles have not been formed. What we were seeing was all of this. So we saw a sweep starting from here. We entered the trade, and all of this was happening when we were in the trade. Then all of a sudden, the fair value gap was respected. The price started going down, going down. We are waiting for a swing. We see a swing here. This is a swing here. We take our profit from here. Price still went down, but price is still behaving like this. Right now, we're actually in profit if we are in that trade. But of course, it has done that move already. Then if you go to H4, you can still see if there's any other move in that market. So if you take the move from here to here, where is your stop loss? Your stop loss is above the fair value gap in the H4 time frame. In the H4 time frame, let me put where your stop loss would have been. Short position. So if you are in this trade, your stop loss would have been above that swing. Your take profit will be exactly this place here. So what risk reward ratio is this? This is 1:. This is more than 1:3. More than 1:3, which is exactly what we want. We enter from here and we're able to come down here. So this strategy can actually give you 1:3. You can see that clearly. I use one of the most difficult to analyze market, which is the BTC, and we see how it played out. I want to take question. I don't want to dwell on this analysis because this is what we'll be doing tomorrow now. Tomorrow we'll be explaining everything. I think I saw a gap on M15. I saw a gap. I wanted to say it when I saw it, but I didn't say it anymore. I kept quiet on it. I saw a gap. And I saw volume imbalance. Do you notice volume imbalance is here? This is volume imbalance. What's happened with volume imbalance when it occurred? Do you notice that it was nicely respected? Do you notice that this is the volume imbalance that was formed? After the market formed volume imbalance, do you notice that the market came down and nicely respected it? But it didn't come to 50% consequent encroachment. It didn't come there, but it respected it. Let's see in the future. Did it respect it? In the future, it broke it. As it broke it, you are looking for 50%. You didn't see 50%. If you entered here, it will close above, so you have to get out again. So I think this is the only trade here, this volume imbalance, this side of the volume, this side of the trade, this side here. This is the only trade we have here, volume imbalance here. Then I see also a gap. I see a gap. You see the gap? Even though the gap was violated here. But let me look. This is another volume imbalance. See another one. Bitcoin is very crazy. See volume imbalance again. What happened with it after it was formed? Volume imbalance was formed. What happened? It was nicely respected. Price came back, respected it, tested it, and went up. So if you take 50% here, you are going to be in profits on that volume imbalance. Depending on where it's happening. If there's a liquidity sweep, there's an order block, and all of those things, it's going to add up to. But let me go to H4. Tomorrow we will do more of this analysis, describing all of these things on the chart, pointing them out, drawing them out, asking questions. Do you notice this? Do you notice that? Can you find this? Can you find that? We'll do that tomorrow. Let me take question so we don't overflog this topic we discussed today. Do you have any question? Our time is up. We need to go 33 minutes past 10. Do you have any question? No question. That means I have taught very well, or I have not even taught at all. Yesterday we had some questions now, so I want to have questions today. Do you have any question? Please send me question on the chat box. Okay, they are typing. Do you have any question? I see a lot of people on the chat. A lot of people on the chat. You are such a great teacher. The guy say I taught well, so that's why there's no question. So we are going to leave it here, and I want you to go and watch. Well, I don't want to give you so much work, but find time to watch this class again. Watch it again. It's on YouTube. Watch it again 2 times, 3 times, 4 times. It will make more sense when you watch it again. You will hear me say those words again and again, and it will make sense by the time we start doing the analysis. Then number 2, I want you to, somebody say excellent, somebody say thanks a lot. I want you to take a screenshot of your own chart, identify any of the things we learned today. We learned swing highs, equal low, order block, high probability order block, of course, fair value gap since yesterday. So if you can locate any of these things we learned, we also learned discount and premium. If you can identify it in a chart, screenshot it, label it, and post in the WhatsApp group. That is your assignment. If you're able to post that, I will regard you as an excellent student of this class. Yes. But if you're not able to post that, I'll regard you as those people who come, they learn, they don't go back to practice what they have learned. So tonight, before you sleep, open the chat. Find at least one thing you've learned from today's class, screenshot it, identify it, label it on top of your chart, post it in the group. I want to see what people learned from the class. Very, very important to me before tomorrow. So if you learned something, find it in the chat, circle it, screenshot it, label it, and put it on the chat room so that other people can see what you've learned from the chat. Thank you so much.